Did you realize Walmart manages over 10,000 global locations, yet faces a staggering financial puzzle, a nearly $23 billion working capital deficit? We meticulously analyzed Walmart's balance sheet, profitability, cash flow strategy, and valuation, uncovering surprising insights you'll definitely want to see. Walmart, headquartered in Bentonville, Arkansas, is a global retail powerhouse operating over 10,000 stores and diverse e-commerce platforms such as Flipkart and PhonePe, with dominant private brands like Equate and AthleticWorks, positioning it strategically for robust digital growth, but facing significant competition from online retail giants. The balance sheet shows increasing financial pressure as Walmart's working capital deficit grew notably to nearly $23 billion, driven mainly by timing issues with payments and a strategic rise in long-term debt. While increased inventories indicate healthier sales, the decision to add roughly $5 billion of debt signals management's choice to leverage favorable borrowing conditions. Investors must be mindful that maintaining liquidity through rising debt could pose risks if growth slows or market conditions shift unfavorably. Here's a screenshot of the full balance sheet. Equity is 1/3 of assets, while current ratio below 1 shows reliance on inventory turnover and vendor financing. Walmart's income statement shows slight improvement in gross profitability, driven mainly by tighter inventory control and fewer markdowns. Revenue grew by roughly $4 billion thanks to increased transactions in groceries and health products globally. But the rise in operating expenses due to higher depreciation and casualty claims raises concerns. From a value investor's perspective, controlling these costs will be crucial going forward, as higher operating expenses can pressure profits, limiting the company's ability to sustain earnings growth compared to industry peers. Here's a screenshot of the full income statement. Revenue up, yet pre-tax profit slid to $6 billion, pulling margin near 3% versus 4% last year, suggesting pricing weakness and possible dividend strain. A proprietary Bow score reveals Walmart's margins hold up relatively well within retail, but it trails significantly behind the broader market, highlighting potential concerns around profitability. Walmart's revenue growth remains strong, driven by increased e-commerce demand. However, net income margins have been inconsistent, indicating some costs are still challenging to control. Ideally, stable or improving margins signal strong profitability compared to peers like Costco, who consistently maintain higher net margins. Walmart must continue strategic investments into efficiency and cost management to capture sustainable profit from rising sales. Investors should closely monitor margin improvements to gauge future earnings stability. The cash flow statement reveals Walmart's improved cash generation ability, with a notable rise of over $1 billion in operating cash, reflecting strengthened profitability. Despite higher capital spending on strategic priorities, free cash flow increased almost $1 billion, signaling efficient capital management. This positive trend gives Walmart valuable financial flexibility, a key advantage for navigating market uncertainty and reinvesting thoughtfully into future growth, something value investors closely monitor when evaluating company stability. Here is a screenshot of the full cash flow statement. Operating inflow tops $5 billion, working capital drains $1 billion. Debt-funded buybacks of $4.5 billion add leverage risk as cash rises. Walmart's latest quarter showed solid growth, with net sales rising nearly 5% and operating income increasing even faster, indicating improved operational efficiency, particularly in inventory management and e-commerce operations. Notably, international markets like Mexico, India, and China are performing well, diversifying revenue streams. Despite strong recent results, management remains cautious about potential economic volatility ahead. However, continued investment in automation, private labels, and membership programs, along with integrating AI for enhanced customer experience, positions Walmart strategically for stable profitability and could present attractive opportunities for value investors. Analysts forecast Walmart's net income reaching nearly $29 billion by 2030, reflecting solid growth driven by strategic initiatives and improved operations. Similarly, rising earnings per share indicate efficient capital allocation and profitability enhancement. However, investors should remain mindful of potential risks from broader economic challenges, such as inflation and currency exchange fluctuations, impacting future performance. Walmart's proprietary Bow scores reveal weaknesses in net income compared to the industry and broader market, while earnings per share underperform significantly against the wider index. Walmart's relatively high price to earnings and price to book ratios signal investors high valuation expectations compared to peers like Target or BJ's, yet remain below Costco's premium levels. Although robust ratios imply market confidence, it also suggests less room for error going forward and underlines the need for strategic initiatives to sustain this market perception amidst competitive pressures. Walmart shows moderate valuation strength within its industry on earnings multiples, but notably trails peers and the broader market on book value, indicating possible asset efficiency concerns. Our discounted cash flow valuation suggests Walmart could deliver meaningful investor value with an estimated share value around $36, driven by expected revenues growing to nearly $872 billion by 2030. The relatively conservative 7.1% weighted cost signals efficient capital management, providing stability amidst evolving competitive pressures and market volatility. Walmart shows significant weakness in our proprietary Bow valuation score, signaling its discounted cash flow potential trails over 80% of industry peers and the broader index. Walmart's price forecasts reflect management's confidence in navigating economic uncertainty, highlighting stable growth and effective strategic decisions compared to industry peers, indicating robust potential for value investors. Walmart shows positive analyst sentiment, notably outperforming the broader market, but there's still room to strengthen its position relative to industry leaders, according to our proprietary Bow score. Walmart's strategic debt uptake and operational improvements bolster cash flow, yet margin volatility and elevated operating costs remain key vulnerabilities. With equity representing merely 1/3 of assets and valuation multiples implying limited margin for error, prudent investors must closely track Walmart's efficiency initiatives and cost management to safeguard future returns. Make sure to watch another video from our Value Explorer series by clicking the playlist below.